This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Holistic Survival Show with Jason Hartman. The economic storm brewing around the world is set to spill into all aspects of our lives. Are you prepared? Where are you going to turn for the critical life skills necessary to survive and prosper? The Holistic Survival Show is your family's insurance for a better life. Jason will teach you to think independently, to understand threats, and how to create the ultimate action plan. Sudden change or worst case scenario, you'll be ready. Welcome to Holistic Survival, your key resource for protecting the people, places, and profits you care about in uncertain times. Ladies and gentlemen, your host, Jason Hartman.
It is my pleasure to welcome my good friend Mark Moss back to the show. You've heard his stuff. He's so prolific, producing tons of content, interviewing all kinds of great people, including yours truly, of course. And it's great to have Mark back on the show. How you doing, Mark?
Yeah, Jason, it's always a pleasure being back to you. I love hanging out and talking. So, man, we've already ripped for quite a while before. We should have been recording it, but man, always love to be back. Thanks.
Yeah. Well, you said something to me before we started today that I was just really impressed, and it shows where your heart is and where your character and integrity are, of how you want to get away from this sensationalized clickbait media that we have. And, I've been railing on that for a long time. We scroll through YouTube and podcast and just mainstream news too. And all we see are like doom and gloom. The sky is falling, Is it really? I mean, what do you think? You're a macro guy.
Yeah. So, just in regards to that, the problem is that, and we know this from a bigger standpoint. We know like mainstream media divides us by running, things that fuel rage or fear. And so we know the mainstream media does it, but we don't really maybe think about it being done to us in sort of like our YouTube sort of circles that we're in this case, macroeconomic type circles and things like that. But unfortunately, humans are very basic at their core, right? You learn this in marketing 101. It's like we're motivated by greed and fear. Mm-hmm. Pain and pleasure, right? That's it. And so those are the two levers. And unfortunately, the fear, because we're always alert to danger, the fear sort of rings a little bit more true than the greed. So those are the two levers that we want to pull. And unfortunately, in the financial space specifically, I mean, the doom and gloom has just been never ending. Yeah. And I think it's just too much, And unfortunately, it starts to become a game that I'm forced to play because I'm competing for attention like everybody else. Yep. And it's not me. It's not authentic to me. And I don't really like that. So that's sort of what we were talking about. But back to the question, is it all doom and gloom? Yeah. Well, it depends. Overall, no. The answer is no. In my opinion, it's no to me. To some people, it could be. So what do I mean by that? Well, first of all, what is your time horizon? So I bought a house. I bought lots of houses, but I bought a new home, which is different, in 2021. And I was like, oh, man, what are you doing? Don't you know it's the top of the market? Don't you know it's going to be horrible, blah, 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 blah. I'm like, look, I don't care if the price of the house drops 50% because I'm going to own this home forever. It's going to be up. I think home prices are up 50% in 3 years from now. What do I care what happens in the meantime? So one is like my time horizon on that. Obviously, but for your audience, I'm big in the Bitcoin space. I speak at all the big Bitcoin conferences. I've been buying and talking about for a long time. And it's like, oh my gosh, should I buy Bitcoin now or will it go back down? Like, who cares? It's going to be $1 million in 8 years or 9 years. Like, right. And so what is the time horizon? Two, just overall, is it all doom and gloom? And it depends on what your definition of doom and gloom is. I am an inflation bull. I just think, and we talked about this, there's some financial analysts that are so deep into the data and the analytics that I think they missed the bigger picture. And you see, to understand these bigger things, you have to, one, pull your head up and look at bigger things, but you also have to have multiple disciplines. So for example, philosophy, psychology, human intention, greed, things like that. So for example, what do I mean by that? Well, a lot of people, Harry Dent, he spoke at my conference. I've read 5 of his books. I keep reading his books because his data is good. His analysis and interpretation of that has been wrong. Yep. I used him, unfortunately, sorry, Harry, but I used him in one of my presentations, and I have him for the last 12 years predicting a 90% market crash. Yep. 3 times I pulled videos, 3 times last year, 90%, 90%, 90%. I have a video from him in June saying if it doesn't happen, or I think it was in May, if it doesn't happen by June, I'm going to have to call it off. But he hasn't. And he's back on Kitco again 2 weeks ago saying another 90% crap. Like, he'll be right eventually.
Hey, Mark, I'll tell you something. I've been following Harry's work since the late 90s. Okay. And he had a great track record for quite a while. He was sort of a god in the financial services industry, got paid a fortune for big speaking engagements. He's been on my show 11 times now. And every time it's just like the end of the world, the bubble's going to pop, the bubble's going to pop. But, and I want you to get to your point of the multidisciplinary thing, right? Because I think that's so important. These people that can't see the forest through the trees, right, and they cling to one narrative and they just keep repeating it forever, regardless of outside evidence. So for example, in that light, there's just a lot more to it sometimes than these sort of micro analysis. It always looks like the bubble's big at whatever point you are in history, but they never know how big it can be. That's a question nobody can answer. And let me just give you another example. I remember one time I was interviewing a Berkeley professor. You probably know where I'm going with this one, okay? And he was the author of a few different books on the population explosion, how the Earth can't sustain the population. And, at the time, we hadn't quite hit the 8 billion mark yet. We were almost there. Now we're over that. And he was going on and on railing about how the Earth can't support the population. We got to reduce the population. And, I usually give them the why don't you commit suicide question, yeah, or, what do we do? Are we supposed to have a genocidal dictator? But this time I just said, they said the same thing when we were at 2 billion people. And then at 5 billion. And now they're saying at 8 billion. What is the number? And he could not give me a number. I said, can the Earth sustain 12 billion, 20 billion, 40 billion? Yeah. He doesn't know. Nobody knows, right?
Because maybe there is no such number.
Right.
And the reason why, and this is a little bit sidetrack here, but it's about capitalism. And so when I say capitalism, I'm not talking about a political modality as it's sort of referred to today. Capitalism is just natural and emergent process. I have private property. I have limited resources, and I try to use those limited resources more efficiently. And then cooperatively, we trade in order to improve both of our lives. And that's kind of how I think about capitalism. So what happens is as something becomes scarce, like we had the whole world operated on a theory of peak energy. Remember that?
Yep.
We're going to run out of energy.
The 70s, oil, the biggest thing,
peak oil. Peak oil is what it was. So, oh my gosh, we're going to run out of oil. We're going to run out of oil. Well, 2 things happen. One, as we start running, if hypothetically we start running out of oil, well, not hypothetically, that's what happened. As we start running out of oil, supply and demand pushes the price up.
Yep.
George, our good friend George Gammon, says high prices are the cure for high prices. So right, as the high prices go up, 2 things happen. One, people use less of it. So that's one, it cuts that off. And 2, people are incentivized to go find new things. And that's what happened in 2008. We came up with a new technology called horizontal drilling or fracking. Yep. And we have more energy than we know what to do with now.
And not only that, we also, on the demand side, we find ways to make the oil we have go further. So if you look at automobiles, for example, they've become tremendously efficient.
Right.
You can get a Chevy Suburban now that gets the mileage of what a little crappy tiny car got years ago. It's amazing how efficient these cars have been getting.
Yeah. And the same with the food, right? So, hey, we have too many people, we can't feed them. Well, we're so much more efficient with growing food now. We can grow so much more than we used to. And so that's why it's like maybe we don't ever get there. We don't know. And that's why they can't answer these questions. But back to the doom and gloomers. So there's plenty of doom and gloom that we can constantly throw. And back to the Harry Dents and people like him. Their analysis is correct. The problem that they have is they think very linear and they think about constraints in the market without realizing the human side of things, like the greed side. So for example, every time, back to every one of these guys, they continually think that the central banks, the governments' backs are against the wall. This is it. Checkmate, right? Like it's a linear game like chess, which is pretty complex, but checkmate, right? Yep. But they fail to think about how many more magic tricks the Fed or the central banks have up their sleeve.
Exactly.
And so I had a dinner. I spoke at this Vancouver Resource Investor Conference a week ago up in Vancouver. I had dinner with Brent Johnson, our friend Brent Dollar Milkshake guy, and Adam Taggart from Wealthion. It was a good conversation. We should have recorded it. It would have been amazing over dinner. But the question I kept posing to them was, because Adam is in the bear camp for sure.
Yeah, Adam is wrong and Brent is right.
I think Brent is more right, right? And so Adam is in the bear camp for sure. And he's like, but Mark, what about the inversion? And what about the debt? And what about the corporate bonds? They lock that in, but all those corporate bonds have to be rolled over. How are they going to do that? And my answer to all of those was, great. So what if the Fed just takes all those bonds on their books like they did before? Oh, but Mark, don't you know there's $2.9 trillion of commercial real estate mortgage-backed bonds that have to get rolled over? They're getting
They
default.
can just bail that out too.
Or the Fed puts that on the books. Oh, but don't you see? I mean, now you see all over the news right now. Don't you see the BTFP is ending in March? That's certain destruction. The bank's going to collapse. Or they just extend
They'll just do another thing.
Or they just, but Mark, the economy, everyone's going to lose their jobs, so they'll send out $1,200 checks to everybody. Like, like where like
they'll extend unemployment benefits. They'll do whatever they need to do.
Exactly. And so like they look at these constraints like it's like this fixed game that someone's going to play by the rules without failing to realize that the rules have changed. And part of my analysis into this, and I've done some videos where I literally broke this down. I don't have all the dates and numbers in front of me, but I'll kind of give you the overview of it. Let me tell you a story first. You told me a story. I'll tell you a story.
Okay.
So Albert Einstein, arguably, one of the smartest people in history, he was a professor. And when he was a professor, he would obviously give his students a test. And every year he gave the same test, like the actual same one with the same questions and everything. And one of his student aides came up to him and said, hey, excuse me, all sheepish. I don't want to offend you, but do you realize that you just gave out the same test that you gave out last year?
Right.
I just don't know if you realize that. And he said, yeah, I do. Well, don't you think that like the students from last year are going to give the answers to the new students and they're just going to like probably cheat or whatever? And Albert Einstein said, the answers have changed. And you see what happens is what that means is as new information comes, we have to be willing to change our mind because the answers change.
Even though the question is still the same.
The question is still the same, but the answers change. And I know famous last words this time is different. Famous last words this time is different, but it is. And so what do I mean by that? In 2008, the way that central banks interact in markets and economies changed. We saw the start of quantitative easing. They started buying mortgage-backed securities, putting them on their books, buying bonds, propping up the market. Okay. So we hadn't seen that before. Sure, throughout history, we've seen it. Japan tried a little bit, but basically 2008 marked the time that we saw it in the US and really changed the market. Now, since that time, it's only gotten bigger and faster and more developed. Let me give you some dates off the top of my head here. So in 2006, you remember this, in 2006, the real estate market started crashing. Home starts were down 26%. That's a crash. Okay, that's a crash. But it wasn't until 2008, almost 3 years, 2.5 years later, before the Fed actually got some sort of a bailout together. They did nothing. Let me show you a couple other things. When Bear Stearns went bankrupt, that is basically looked at as the trigger that caused the entire banking collapse to cascade down, right? It took 7 months from the time Bear Stearns went bankrupt before the Fed did anything to help the banking crisis. In March of 2023, when the banks collapsed, it took 6 days.
So they learn lessons and they act faster.
But it's even more than that. So yes, they've learned lessons, but it's even more than that, Jason. What happened in 2008 was the first time we saw them. Now, look, I get it. Keynesian economics, the whole point of Keynesian economics is to sort of paper over these dips and so forth. I get it. So they've been doing this for a long time, but it was a big shift. It was a big change in 2008. And so let me give you a couple other things. So we saw the bailout. So we saw the $700 billion bailout, the TARP package, then it ended up being about $1 trillion. But let's fast forward. So they were reactionary. They watched Bear Stearns collapse. They waited 7 months. They reacted, but they reacted very slow. Okay. And if we look at fast forward, let's go to 2020. In 2020, when the markets crashed, within weeks, we had trillions of dollars of bailout packages already in the markets, right? We had the $1.2 trillion, the $1.7 trillion package they put out. Then over the next 90 days, the Federal Reserve opened up 13 special funding facilities to buy everything in the market, including buying equities indirectly.
Right.
Okay. But now they went from reacting very, very, very slow to reacting like lightning fast. Okay. But here's what's changed. Now they're no longer reacting. Now they're preemptively moving.
They're proacting. So what does that mean? Let me give you some examples. So the BTFP is an example, but that was like sort of like a reaction, but the finger was on the trigger, right? But what they've done now, for example, Brent Johnson didn't get this, but we talked it out, is they've gone around and opened up swap lines with all of these nations, and not just our friendly nations, like most of the developed nations, like 13 of them, I think, at the top of my head. What does that mean? That's like a credit card. Okay. So like my kids, I give my kids a credit card. If you get into trouble, use this card. They don't have to call me. I don't have to wire money over Western Union. They just have it. So all these nations, at the first sign of trouble, boom, they can just tap into as much money as they want. Mm-hmm.
So that's proactively moving, right? And so I think when you look at the answers being changed, when you look at data pre-2008 and you make your assumptions based off of the checkmate of what the Fed or the Treasury will do, because this is what happened in the 70s or in the 60s or the 40s, like it was a different time then.
Yeah, of course it
And,
was.
and so I think people just haven't realized that. And so back to just kind of all the way back to the first question, am I bullish or bearish? I'm bullish. I'm not as bearish. I don't see doom and gloom because I think they're going to keep papering over it. Now, that's not a good thing. And in my opinion, it's
not
actually
a healthy
worse.
thing overall, no question.
It's actually worse. Okay. It's actually worse. We'd be better off having a big crash,
right?
Because then it resets the game and it allows new entrants to get back into the game. Now, my kids could one day buy things and, whatever. It's like if you and I were playing a game and it never ended and all these people are like, well, I want to play. So we want to reset the game. And unfortunately, instead of the crash like everybody's expecting, I think it's a crash up. And most people never get that chance. Now, eventually, the law of diminishing returns says that eventually the game is over.
Yeah.
And we're already there. Let me tell you what I mean by that. In Keynesian economics, they use debt to stimulate the economy. The goal is to take on $1 worth of debt to get $2 worth of growth.
Right.
Once you get past 90% debt to GDP, the Keynesian multiplier starts to work against you. So instead of $1 debt, $2 of growth, now you get $1 debt, $1.50 growth.
And is that because of the interest equation where you're paying more interest than you get in revenue?
That's part of it, but it's just the law of diminishing returns.
Right.
If a little bit is good, it doesn't mean like a whole lot is good.
In other words, maybe an allegory to it would be, you wake up, you have a cup of coffee, an hour later you have a second cup, which is pretty much what I do. and
I'm drinking my coffee.
and you get some energy. But if you drink 10 more cups, it's not going to work, right? It's going to have a diminishing return and make you feel sick.
Right. So the debt becomes unproductive. So instead of debt going to productive things that have a good high use and return, the debt goes to unproductive things, which have less growth. So let me just fast forward. So to save time, I know we have short time today. Yeah. Where we're at today, right now, we're getting $1 of deficit spending for 60 cents of growth. Mm-hmm. We're getting $1 of debt for 40 cents of growth. That's digging a hole deeper.
Yeah, right.
Okay. So eventually it goes to 20 cents and then it goes to 10 cents, 5 cents. And eventually there's no growth for the debt. So eventually this ends. Yeah. But I think, if I put my prediction hat on, and this is a conversation Brett and I had, and we agree on this, I think we see $100 trillion in the debt before the game ends.
Yeah. And so we're at 34 trillion now. And that's the thing I always say, Mark, nobody knows how long they can kick this can down the road, right? It's all unhealthy. No one would say it's good and it's okay, except maybe some bad people on the far left.
Yeah.
But the question is, how long can it go?
Yeah. So it's the law of diminishing returns. So I think we just watch that and we watch as that growth continues dropping from 40 cents, 20 cents, 10 cents, and we'll see when it finally goes. Or, and that's ultimately, that's where I put my base case. Eventually things get bad like Argentina, and then the people realize it and they vote somebody else in, like Miele maybe. Yep. But I think this law of diminishing returns. Now, back to the super smart analysts that don't take into the rest of this human psychology into effect. So if you think about who's really running the world, and not get into the like crazy stuff here, conspiracy stuff, but like it's the corporations and the bankers, right? Like that's who lobbies the government and writes the laws, right? So it's the corporations and bankers. They cannot let this system crash. Why would they? Why would any government or central banker allow the whole game to come crashing down and end and they lose everything when they could choose to print? So when they're forced between these two, and then what a lot of people want to push back on this one, Jason, I'll throw this out and I'll take a pause here. But a lot of people push back is like, Mark, but you don't understand. The Fed's fighting inflation. If they do this, we're going to have massive inflation. The people are going to get pissed. They're going to be rioting or, whatever. Yes, that is true. The people will be pissed over higher inflation. But when given two choices, you have to understand you have two choices. Do I want massive deflation and I want to lose everything I own? Or do I want a little bit more inflation? They're going to choose inflation every time.
I totally agree with you. And you know what? They're going to choose inflation because it's, even though people, think it's usually relatively slow, like it's not an overnight thing like, hey, we're going to end Social Security or we're going to end disability insurance programs, right? It's not that sudden. Inflation is this gradual boil the frog type of idea, right? And it benefits the elites the most because of the Cantillon effect, right? They're close to the money printer and they benefit from the inflation actually, and they own assets that are basically hedged against inflation, and they have debt, which declines with inflation. So Yes, inflation is the business plan. Absolutely.
Yeah. Yeah. And then I would also say that I think it's important for people to understand this. And I talk about this all the time. And I know you worked out this whole Hartman index or whatever it was called. And so thinking about things not in terms of dollars, but in purchasing power.
Right.
Right.
Yep.
And so if you can put your mind into that sort of a frame for a minute, and you think about what is a crash. Everyone's afraid of a crash, right? Doom and gloom. Oh, it's going to crash, So what is a crash? A crash, the way that I see it and define it, would be that something happens where my pay goes down, I lose my job, I get a lower paying job, I lose my, the value of my home, value of my retirement accounts go down, and I can no longer afford the same quality of life I had before.
Right.
Okay, let's just frame it up as that. So something happens to my income and my wealth, my investments, so I can no longer afford the same quality of life I had before.
It's a big loss in purchasing power.
Yeah. So now if we define it that way, then we can have a crash down. That's what people are afraid of, 2008, 2000, right? The generals fighting the last war, so to speak. But we can also have a crash up, meaning that prices go up so fast, but my pay doesn't rise with them. And I can also no longer afford the same quality of life. Yep. The outcome for me and for most Americans is the same. My quality of life goes down. Whether prices went up or down doesn't matter. The outcome to me is the same. So now we have to figure out, how do we protect ourselves from that? And the reason why it's important is you have to understand, what am I trying to protect from?
Yeah.
Am I trying to protect from a crash down or a crash up?
Right. Deflation or inflation.
Deflation or inflation. Exactly.
Right. Okay. So what is the answer to that? But also, I want to make sure you address the yield curve, because we talked about that a little bit beforehand. And, you just said a great line. I love it. The general fighting the last war. That's really good.
So let's talk about the yield curve for a minute. Now, look, I'll self-admit here, like I said, there's plenty of people that are into the weeds and way more detail than this. But I think I have maybe a better grasp on some other disciplines, and we can bring this together. So let's just understand the yield curve. The yield curve is the curve of what the bonds pay the yields. So short-term debt pays less, long-term debt pays more. It makes sense, right? Because if Jason, hey, loan me $20 till tomorrow, like, you'll give me $20, no big deal. If I said, Jason, give me $5,000 for 2 years, you're going to want some return, right? So we want more return for the longer risk. The yield curve,
value of money.
Right. The yield curve has been inverted because short-term money is more expensive than long-term. Now, some of our friends talk about the yield curve, and how 100% of the time it's said there's a recession coming. But what we want to do, a saying that I've sort of modeled my business and life off of, is success leaves clues. That doesn't mean copy the exact same thing. It means try to understand the mechanism of how it worked and do the same mechanism. So what is the mechanism of the yield curve, and why does it tell us there's a recession coming? Well, the mechanism works like this. If the long-term money gets cheaper than the short-term money, then the market is saying that there's going to be a recession coming. And if a recession comes, the Fed will lower rates. So if rates are lower in the future, that means the Fed's going to cut rates, and that means that the market is pricing in a recession. Okay, that's historically been correct. But remember, the way the central banks work in the markets is different today. So what we're seeing today is something different. We're not in a recession, and the Fed are lowering rates. So, whoa, hang on, this is different. That's not what we had before. So they're sort of proving that whole mechanism to be different this time. So anyway, that's sort of my thought on it. Now, okay, the Fed has paused rates. We know there's rate cuts coming. The market's pricing in 6 of them. Jerome Powell was on the news this week at the FOMC meeting. He's trying to say, whoa, we're going to slow it down. There's going to be 3, maybe not March. Maybe we'll push it back to May. Like, he's trying to jawbone that. I think that the Treasury is front loading the bills, trying to force the Fed's hand into action. I saw some stuff on Twitter today with the new jobs reports that came out, and they're saying that they want to have a big jobs miss. They, like the BLS, the government, the Treasury, want to have a big jobs miss so that they can force the Fed into action. Because the last thing, the Fed, people think the Fed's not really looking at CPI. They're looking more like a PCE, which is like a better measure for them. But really what they're looking at is the unemployment, because the unemployment moves very slowly. And if it starts getting away from them, it could take a long time to get it back up. And so if they could show, back to this new report that just came out from the BLS, if they could show a big jobs miss, that would really move the Fed forward and into action. And so the point that I'm making is that the Fed and the Treasury are sort of fighting. They're sort of at odds here, where the Fed is trying to slow inflation and keep the dollar propped up, but the Treasury's going broke. $1 trillion just in interest on the debt. Tax revenues are dropping. So the Treasury needs interest rates to come down and they need revenues to come back up. So they need the Fed to lower the rates. And so I think by front loading the bills, and then, like I said, with this new jobs report that came out today, potentially trying to trigger some sort of a pivot, I think the Fed's going to pivot sooner. And anyway, back to the point I'm making is like, we haven't seen a recession and yet rates are already starting to come back down.
Right.
The other thing I would say, just one more thing, and I'll take a break here, is back to some of our friends who are super into the weeds and super analytical on this. Yeah. They'll say, but Mark, this isn't QE. Look, they haven't done QE. Okay, sure. In March of last year, they didn't do QE. They didn't even pivot. Technically, they stayed in a tightening stance, but they injected $100 billion into the banking industry, and that sent the markets higher. So just because it doesn't fit your technical definition of what quantitative easing is, doesn't change the fact that they did something to backstop the market, show that the Fed put is still there and push it higher. I had a conversation with Jeff Snyder at George's event, and he's like, but Mark, don't you see the Fed didn't even do anything, and yet the markets went up? I'm like, technically, you're correct. They didn't inject money, but they said that they were going to do something, and their words drove the market. And so that's sort of what I'm talking about there.
Yeah. No question about it. So, this maniacal focus on things like the yield curve, talk about fighting the last war. There's way more to life than the yield curve. I remember Ken McElroy and his wife, Danielle, were interviewing me on their show. And they said, yeah, Jason, you're so optimistic about the real estate market, but, George says this and that and the yield curve. And I said, look, all these 135 million people with either super cheap mortgages or 42% of them with no mortgage at all, they don't care about the yield curve. All they know is that they've got an incredible deal on housing that cannot be duplicated. It's impossible to duplicate how good a deal they have, and they have 28 years left. That's why there's no inventory, and there's not going to be a lot of inventory because those people are only thinking about that. Now, they didn't say this, but, I'm debating myself. Okay, Jason, well, if the yield curve influences the economy and means there's going to be a recession, the people could lose their job. And that's why I went to the trouble of researching what I talked about on your show recently, which is even on unemployment insurance, they could handily qualify for the loan they already have.
Right.
I mean, their debt to income ratios are superb. Based on unemployment insurance. And that would be like the worst thing ever, right?
Yeah.
If they had no side hustle, nothing, right? So
I do want to just
and if the benefits weren't expanded like they usually are during recessions.
I do want to just reinforce to kind of to walk some of this bullishness back. First of all, as I said, it's not bullish. A crash would actually be much better for us, right? So it's not bullish. It's just the direction is what I'm talking about here.
Right.
Second of all, nothing ever has moved up or down in a straight line. Things crash and then they have bounces, or things go up and they have dips. So nothing moves in a straight line. I'm an inflation bull because I understand the governments are at this last stages of their empire and they have no choice but to print an ungodly amount of money. So that's the trend, but it's extremely volatile. So if you look at like Weimar Republic, you see the chart of the gold to German mark ratio, and over 9 years, it's like a hockey stick. But if you overlay volatility, it was so volatile that people kept getting shaken out. So I think this is a lot of volatility. I mean, we have a dozen sort of pinpricks or gray swans that we can see right now, obviously with the election, and we have the liquidity concerns, and we have obviously immigration, we got wars. I mean, no shortage of potential pinpricks here. So volatility, yes, but what is the direction we're in? And I just go back to human nature and greed. When your back is against the wall, do you just choose to die, or do you hit the printer? And you're just going to hit the printer.
Exactly. Yeah. That's what they will always do. And that only question is, how long can they kick the can down the road? Earlier, you said maybe $100 trillion is the number where the jig is up. So here's the question, Mark. Let's project out. And I know
I didn't say it ends at 100. I said I think we get to 100 before it ends.
Okay, fair enough. So my question is, let's project. How long does it take to get to $100 trillion in debt? I mean, it has to triple from where it is now. How long does that take?
Well, the CBO, Congressional Budget Office, projects we'll be at 50 by the end of the decade.
Wow. Okay.
That's their projection, but I'm sure
maybe by 2035, we're at 100 trillion possibly, right?
I would say by 2035, we're there. I mean, again, CBO says 50 by the end of the decade. I think that's undershooting. We're basically adding about $1 trillion every 90 days right now. Right. So, probably 2035 is probably a pretty good bet.
Yeah. Yeah, interesting. So when we get there, do we experience just a massive like stagflationary sort of anemic economy? Is that what happens at that point?
Yeah, I think that's what happens. And the reason why is back to sort of the diminishing returns, which is money is going into unproductive areas.
Yeah.
And so, like, if each dollar is being used efficiently, then we have growth. But when you squander it and waste it, you have slow growth, right? And so, I think as this continues, what we're seeing is the governments around the world, in the United States as well, continues to play a bigger role of GDP. And of course, we know governments are anything but efficient with their money. And so, we continue to see this inefficient blob take over more and more of the market, and that ultimately just kind of stalls things out. Yeah, and then it's sort of like running up a hill with a big weight, with a backpack full of rocks on you. Now you have all this debt. You're trying to carry that. Instead of allowing the natural process of creative destruction, like in 2020, we saw a lot of these airlines get bailed out, for example. Like, man, if they would have been able to go bankrupt, wipe out about a bunch of that debt and have a new group come in, buy them up and revitalize them, then we could have seen massive growth for the airline industry coming out of that. But instead, we just put the patient on life support. So to answer your question, we have more patients on life support, and they're just sort of like meandering along.
Yeah. That's what we always do in our culture. We never want to take the pill. We never want to take the medicine and do the actual cure and have price discovery and market clearing. We always like paper it over to the next thing. It's just the way it is. It's the way it is. Mark, anything I didn't ask you that you want to share? Just anything you've got going or anything you want to talk about?
One, I think, as bad as all this sounds, and again, I think a crash would be better, but I don't think that's where we're headed. There's always a crash coming, but I think the trend is up and to the right. At the same time, as bad as that is, what a time to be alive, Jason. I see people all the time saying we have it worse than generations before us and things like that.
That's just not true.
I just got my wife this brand new Navigator for Christmas, and like, dude, the thing drives by itself, hands-free, heated seats. It's massaging my back as I'm flying down the freeway. I'm chatting on my phone with friends from other countries at the same, like, whoa, right?
It's amazing.
So I think you can focus on the doom and gloom, but you can also realize that all of this money in debt has more money, trillions of dollars moving around the ecosystem all the time. Like, there's never been an easier time or a better time to make more money. Yeah. So you can choose where you want your focus to be. That's sort of my point with that. Yes, things are bad, and unfortunately, things are going in a very bad direction. I know you and I kind of see eye to eye on a lot of the social and political problems, and so we're certainly going in a bad direction. But if we can stop and just look at where we're at, we have it pretty dang good. The other thing I would say is that during that Weimar Republic boom that we had, what happened is because of that massive inflation, but because more importantly, the volatility that happened, people saw prices go up and then crash, up and then crash, up and then crash. But without really understanding what was happening, what they did is they got tricked into thinking, oh my gosh, my gold, my real estate, my assets have never been so high. I should sell them before they crash back down. And what happened at the end when the currency finally collapsed is that they all held a bunch of worthless paper and they had no assets. And the paper ended up being burned in the fireplace because it was worth less than wood.
It's an amazing picture on Wikipedia of that, by the way. Yeah.
Yeah. So I would just say, zoom out, understand what the picture is. Assets are the way to go. You build wealth as assets. The goal is to get more assets. Don't get shaken out. The goal is not to get more paper currency. It's assets.
I completely agree with that. Assets that basically protect you from inflation. Assets are the key, especially those assets everybody wants and needs. And Mark, you alluded to it, but maybe you want to just expand on this, and I'll give you a little bait to do that with. Yesterday, Sam Altman with OpenAI, ChatGPT, was interviewed, and he said that he believes, in fact, they have a betting pool at OpenAI, that of what year we will see the first billion-dollar solopreneur, because these AI tools have democratized power and given so much power to so many solopreneurs and small people that never had this reach and power before that they have with artificial intelligence. So, we know solopreneurs, certainly you and I, that make many millions of dollars a year from their bedroom, right? And now, he's saying, we're going to see the first billion-dollar solopreneur. I don't know. Any thoughts on that?
I mean, it depends on what that classification would be. So, for example, if you're an artist like Kanye West, I mean, you're a billionaire, or he was before he went crazy. Was he a solopreneur? I mean, he's just a recording artist, right? I mean, I think he was $1 billion solopreneur. So I don't know what's her name.
It's a fuzzy definition.
What's her name? Kardashian. She became the first Chloe, I think, or one of them became a billionaire. She got fame and she put her name on a makeup line, right? So was she a solopreneur? So I don't know, but I would say it's certainly getting easier. I think overall, though, I think most people have the wrong opinion of AI from a standpoint of, I think it makes, and this is actually a bigger point, but I think it makes smart people smarter. It doesn't make dumb people smarter. So what do I mean by that? A lot of people point to this hollowing out of the middle class because we sent all our jobs to China. Right. That's partially true, but that's not totally true. What really happened, the bigger driver of that was not that we sent our jobs to China. The bigger driver of that is that the economy changed. You see, in an industrial age through the 1800s and in 1908, Henry Ford created the automobile and mass production. In mass production assembly lines, we all do the same job. You're way smarter than me, but on the assembly line, I put something on, you put something on. So it made dumb people smart and made smart people dumb, and everybody was equal. And we had this massive middle class because everybody was equalized on the assembly line. Today, we've moved from the industrial age. We're in the information age. Everybody already knows this. And so now we're working from home on our computers, and we're only going to be able to do that better with your point with the AI. And what that means is the smarter people get, the more motivated people, the harder working people get further ahead, and the unmotivated, uneducated, unsmart people get further behind because there's no assembly line where we're all doing the exact same job. Now it's the meritocracy where we're working on that. So I think AI, maybe by the end of the decade, maybe in the next 7 years or so, I think we could probably see that. I think we're already getting close. I think there's already several that are probably halfway there. So anyway.
Yeah. Very interesting. Mark, where can people find you?
onemarkmoss.com. Everything's linked there. I'm on YouTube. I make a couple of YouTube videos a week, podcast, radio. So everything's linked there. Social media at onemarkmoss.com. Everything's linked there. Go check it out.
Excellent. Mark Moss, thanks for joining us.
Thank you.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.